You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Mark Longo here from The Options Insider, and I'm breaking into your regularly scheduled program to let you know about a group and an event that I think may interest a lot of you. I know a lot of our readers and our listeners out there are interested in using and applying their options and risk management expertise in a lot of interesting new areas. And maybe you want to become a fund manager or an asset manager. Maybe you want to create a financial technology startup or become an educator. There's a lot of interesting ways you can apply that expertise. And if that sounds like you, well, then I have a group you may be interested in joining. It's called the Options Alliance. We're a group of active financial entrepreneurs and startups. We have a conference every year that explores all of the issues that are important to new startups and new endeavors in this space, including how to market your new venture, how to grow your AUM. Of course, it's a very important metric if you are an asset manager, and perhaps most importantly, how to fund all of those great new endeavors. It's a really unique event. There's nothing else like it out there. So if that sounds like something that might interest you, then clear your calendar for Monday, December 8th, and join us at the Arditi Center for Risk Management right here in Chicago. You can review the full agenda and reserve your seat at www.optionsalliance.org. And now I'll return you to your regularly scheduled program.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. You can check out all 13 programs we have on the network, pretty much wherever our stuff is available, including the mothership, theoptionsinsider.com, or, of course, iTunes, Stitcher, AHA Mobile. Find all 13 programs, including all the archived episodes of Vol Views, archives of Option Block, Options Oddities, Options Bootcamp, the Advisor's Option, all that fun stuff floating around out there. Of course, you can also find it all via the mobile app available for iOS, Android, and the Fire OS. Of course, while you're checking out those outlets, you can also fire off your questions, your comments, your insights you want to share with us, as well as with your fellow listeners of the program. And I am joined today on the old Volatility Views show by my two volatility compatriots, my partners in crime, starting off with the man beaming in from the longest distance, so we'll give him pride of place today. None other than the major domo over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the show, sir.
Hey, I'm really happy to be with you.
Things are cooking over there at BGC, as I can hear in the background yet again. Always a hot day. Even on a slow day, always a hot day over there in BGC land, it sounds like.
Yeah, always something to do.
Slinging cephs left, right, and center, it sounds like. All right. Or slinging swaps, I should say, on the cephs, but c'est la vie. A distinction of little note, since most cephs aren't even trading any volume. But anyway, also joining us, beaming in, sometimes by video, like today, where he shows off his finery that he wears in the office over there. None other than the Greasy Meatball himself, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to the program, sir.
I had a cooler title for the show than Greasy Meatball. I thought that
can't have two major domos, and I already gave Jared
Well,
major
I don't
domo.
want to be the major domo. I want to be the Volatility Viceroy.
Well, then I'm not sure. Alex may have some
Well, we gotta come up with
concerns.
something. How about the Volatility Vicar?
Vicar, the vicar. The vicar is in town, children. Run and hide. That's an interesting one. We can think. You certainly are dressed up a little bit better than a meatball today. I did have that brief glimpse.
Thank you very
the brief
much.
glimpse into the worldwide HQ of Option Pit there. And Mark doesn't always just sit there in his sweatpants and a scruffy beard. Sometimes he cleans up. Listen. So we'll think about it. Maybe listeners can write in and give us their suggestions for. You can be the Greasy Meatball in that other program that shall go unnamed, and we shall call you something else here. Maybe Joe. Who knows? We'll see. Whatever the listeners write in with, we'll go with. All right, so listeners, the ball is in your court. Meanwhile, we're going to keep on rolling right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome back to the Volatility Review. This is, of course, the portion of the program where we break down the week that was from a volatility perspective. And it wasn't, let's say, the most active of weeks from an overall volatility perspective. Not perhaps surprising, given that we are rolling into the tail end of the year here, and doesn't appear there's a lot on the calendar that may be moving and shaking volatility going forward. We saw a range starting off in VIX Cash land, as we are wont to do, of about nearly 15 on the upside, about 14 3/4. Brief flirtation with that, and we trended down. It was a low of a little around 12, but today we're ticking down even more. We are recording this, of course, Friday, December 5th, listeners, for those of you playing the home game, and we're trading right now, or listing at least right now, in the VIX Cash at 1180, so south of the 12 handle and ticking down ever lower as the day increases. We saw some interesting paper going up today in the VIX Options as well. We'll get to that in a little bit when we dive into the options. But first off, let's start off with kind of looking back at the week that was from a vol perspective. I think we'll start off with you, Jared. What caught your eye in this week's activity?
This was a week where markets turned a bit and implied volatility came in. We saw the VIX index move back under 12 in trading on Friday. And, economic data came in extremely strong this morning. So it was, I think, a return to form after the effects of the big move in the markets in mid-October have completely worn off, and the selling from decline in oil has started to normalize. So it was a return to form, and I think a move into the really meaty part of the quiet holiday period.
Yeah, we are starting that move into the meaty period, meaty perhaps being code for not a heck of a lot actually trading. Mr. Sebastian, Mr. formerly known as the Greasy Meatball, certainly soon to be known as perhaps something else. What caught your eye in this week's activity and just volatility trading, sir?
Some really interesting trades this week in VIX, and they kind of agree with what Jared was saying. A couple of just massive out-of-money put trades that point toward a potential collapse of realized volatility, and with it implied. We've now had, 4 days? How many days in a row have we had where the market's been basically doing nothing? Realized volatility is down to back below 7%. We might be, we got a real chance at crashing to those 2% and 3% lows we saw toward the end of November around Thanksgiving time.
Yeah, since you brought him up, we might as well get into that as well. The VIX options activity we saw this week. It was a little bit interesting, a little bit of a head scratcher, at least for some people, maybe not for people who listen to this show on a regular basis. One of the other programs we do on a daily basis here on the network is, of course, our Options Oddities program. We do that live every day in the TD Ameritrade platform. Listeners, so if you have a chance to surf on over noon Central, 1 p.m. Eastern, we'd love for you guys to join us live. And that chat room today was just lighting up with comments about what's going on with these VIX puts, And a lot of the people out there, there's quite a few people in that chat room, and a lot of them simply couldn't fathom why anyone would want to buy a VIX put with the VIX Cash south of the 12 handle. And I had to walk them through kind of exactly what you were saying just there, Mark, that indeed we're looking at a realized vol 10-day at least of about a 6 in the S right now. So when you look at those numbers, a VIX Cash of around 11.5 to 12 seems juicy and seems like a premium. Let's walk people through exactly what we're seeing out here, because it is kind of interesting. We talk a lot about options volume out here from a VIX perspective, listeners on the show, and usually we're talking about how call heavy it is and how much action there is in the calls, how many times the calls outnumber the puts 4.5 to 1. We're not seeing a lot of that these days. We're actually seeing puts lighten up the tape. In particular today, VIX already off to the races, VIX options in particular, doing over 500,000 contracts already just half of the way through the session or so, and about 300,000 or actually 200 some odd thousand coming into puts, and then another 70,000 coming in an interesting call trade. What caught our eye, well, actually started off earlier this week. We saw someone coming in and gobbling about 175,000 up of the 12 half puts, paying anywhere from 9 cents up to nearly 13. We saw more of that going on today. We saw 175,000 of a little bit lower strike this time, the D's 11 half puts going up for prices about a nickel. So they all went up pretty much for about a nickel. Paper buying. Looks like as we're writing this right now, they're bid for more, listeners. They're a nickel bid at a dime. So a lot of size printing on this strike today. Seems like the sellers have backed off a bit as well. They're exhausted. So we're at an equilibrium here of around a nickel for 175,000 contracts. Also seeing about 60,000 of the D's 12 half puts, those puts we saw earlier going up in the week, going up again this week. Again, those were kind of mid-market trading towards the offers. Looks like there's more buying on those as well. And then rounding out the interesting, very near-term paper we're seeing going up in VIX today was 70,000 of the D's 18 calls, those going up for about 23 cents. Again, mid-market, somewhat a little bit closer to the offer. They're about 20 cents at 25 right now. So there's a lot of potential interpretations on there. Obviously, those are opening on the 11 half puts because only 185 contracts open on that strike. So clearly, as 175,000 contracts of opening paper, a little bit murkier on the D's 12 half puts. Are they adding to that? Are they perhaps taking some of that off and rolling down 2x, 3x on the D's 11 half puts? Or maybe are they even legging into a 12 half or 11 half and 18 strangle? That'd be an odd strangle, but we've seen odder things going up. Clearly, either way you cut it, there's a lot of premium buy-in going on out here in VIX land today. Mr. Sebastian, I know you watch all things VIX and VIX options these days. What's your take on this very interesting, very near-term, a lot of it skewing towards the downside paper out here in VIX land today?
I mean, he's making a pretty serious bet that VIX is going to stay sub 12 and maybe sub 11.5 between now and expiration. Frankly, I was surprised that he didn't try and take off some of his previous position earlier in the day. But when he put on some of it, his 12.5s that he owned basically doubled. But now he is, now he's basically strapped it on. He's got the put stupid on. He's got the 12 half, 11 half put stupid. He paid a total of what amounts to about 16 cents for the stupid. So it's I'll be interested to see whether he ends up hitting an absolute home run on this or not.
Yeah, this is an interesting paper. Again, a lot of facets, not just the size, but the near term, the way it's going up, all kinds of interesting stuff going on up here. And you're right, it doesn't look like he's taken off 12 halves. It looks like he's adding to that. So this guy clearly specking that there's some near term downside movement ahead out there in VIX land. And if you pay attention to things like we talk about here on the show, realized versus implied vol, it doesn't seem like the craziest of bets. Jared, what's your take on all of this flurry of paper, a lot of it skewing to the downside out here in VIX options this week, and particularly today?
Yeah, it is pretty curious. Like the 11.5 puts in the VIX, the December 11.5 puts trading today. One of those went up as a block about 99,000 contracts. And when you consider that was for 5 cents, trading at the bid at the time before lunch this morning. That's a pretty big trade in terms of notional value, at least. And to be selling those puts for a nickel, especially as the index level gets now down below 12, it's an interesting trade, and it's kind of ironic actually that we're talking about some of these big trades going up after open interest in the VIX options had been declining so much. It's a little bit unusual maybe counterintuitive even to see so much volume. But I guess part of that is spurred on by some of the data that we've seen today and expectations for the holiday period. So in that respect, we can start to make sense of it.
Yeah, you're kind of referring to the other big story that a lot of people were beating the drum on this week, Business Week, and a few others as well, that open interest out there in VIX options really falling off a cliff going into the end of the year here. Of course, this is a product that some days can do over 1 million contracts a day, doing 500,000 already today. So it's a very robust volume product, and usually over the past year at least, it has averaged about 8 million contracts in open interest. And what we're seeing right now is that actually that's kind of fallen off a cliff to the tune of, as we're speaking, about 5.7. I know earlier in the week it was even lower, around the 5 million handle, which was about 35% off, probably about 30% or so off now, off that average. So substantially off. It got into, actually, for a while there, right after last expiration, got as low as, I believe, about 4.2 million contracts open, which was a record low for the last couple of years out there in VIX land. So clearly, today, notwithstanding, people haven't really felt the need to come out and really open new positions out here in VIX options. It just hasn't been the case. And of course, today now we're seeing 500,000 contracts going up essentially before lunch. So perhaps that narrative has changed a little bit. Certainly someone feeling a little bit of interest and momentum on the downside here on both sides. Someone gobbling those things up. Someone, of course, a lot of people are perhaps willing to sell those things. It's an interesting trade. Either way you look at it, you're right, Jared, it is a little bit dubious to be blasting out 100,000 or so of those for a nickel. Of course, buying them, you could be equally concerned that's going to play out in the time frame allotted here. Either way, it's an interesting trade, certainly one we're going to pay attention to. Moving on to one of the other hot strikes are out here where people are trading and playing out here in this diminished VIX options landscape, at least for the foreseeable future. Remember, these are open interest numbers, so these are kind of updated from yesterday, so we won't have these numbers from today in, but we can maybe insert them ourselves. Starting off the hot strike right now today, the Jan 20, so the call is still leading the charge with about 265,000 of those on the number one spot. Number two, of course, D's 13 puts. Those were the most popular puts with about 260-odd thousand of those contracts open, followed by our strike du jour today, the D's 12 half puts with about 222,000. Of course, if today's open interest is all or mostly opening, we got 223,000 or so open, and then another 62,000 going up today. That will bump it up to the number one spot there. So the D's 13 puts could be, once again, that's been the hot put strike for a long time now out here. It's been vacillating around this strike. I'm sorry, I meant D's 12 half puts. But that and the 13 puts have been the two hot strikes that have kind of been vacillating around. Then number four, we have the D's 20 calls with about 191,000 open. D's 18 calls, 185,000. You've seen the pattern here. A lot of D's, a lot of calls. D's 25 calls for 182,000. Of course, this is where it starts getting interesting too. D's 19s are the number 8 spot with 147,000. But clearly today, 175,000 contracts going up on the D's 11 half puts. That's all opening because there's only about 100 odd contracts open on that strike. So you factor in that 175,000, the number 7 spot is actually the D's 11 half puts these days. So a little bit of change, more puts are rolling up into the mix. And we finish off with D's 14 puts and D's 17 calls, about 115,000 open respectively there. And I said, again, not a lot of open interest still. So these strikes are a little bit off what we've talked about in recent shows, about 5.7 million contracts open. Not as heavy to the calls versus puts as we've seen in past either. Like we said, a lot of put activity going up today, but that's not even reflected in these open interest numbers. And we're talking about 2-to-1 calls to puts, about 3.8 million calls versus about 1.8 million puts. So that's certainly well off the recent highs that we've seen in terms of 4.5-to-1 calls over puts, which was actually occurred the last time the VIX Cash got down in this range. And we speculated then that was because there was a relative dearth of downside strikes. So just structurally, VIX has to get a lot more call heavy when it's down in this range. At least so far, we're not seeing that play out again this time. So maybe that puts a little bit of a hole in that structural theory we had from earlier. Before we move on into some of the other products like commodities and things, anything else catching your guys' eyes out there in the land of equity volatility, Mark and or Jared?
Well, we're seeing honestly, there's a pretty steep contango in the futures. And, so owning any of these ETFs and ETNs is killing you. Although, one note, I don't think the December future is particularly cheap. It's trading at a full, 1.7 points of premium to the cash. So, while contango is steep, there's not a future that sticks out to me as particularly cheap. I thought that was kind of interesting.
That is interesting, because then where do you find your safe haven? You know, if you're looking to escape that roll yield problem, you're kind of screwed no matter where you go at that point, which is kind of interesting. Yeah, of course, you're right. We talked about that a lot here on this program about the ETPs being disadvantaged by that, and clearly in this environment, that's going to disadvantage them even more. We said it many times before, but certainly if you're thinking, oh, VIX Cash is cheap here, I want to buy and hold some VIX. The VXX and those ETPs are not the way to go. So please, listeners, do not go that way. Jared, anything else you wanted to add? I thought I heard you jumping in there earlier.
You know, since you opened it up to anything in equity volatility, I have to say this was pretty quirky, but the move in the Shanghai Composite Index in China this week was, I think, hyperbolic. It was is a fair word. I mean, it was just incredibly fast and steep to the upside. There wasn't any apparent explanation for this. Initially, the link between Hong Kong, the mainland, has been a big story in that market, but the move to the upside in the Chinese A shares was fast and furious. Now, of course, there aren't any listed options on that index yet, although they're making rapid progress in that direction in China. But there is an ETF listed in the U.S. that has fairly active options traded on it. And the ticker is, I think it's ACHR, some kind of acronym sort of representing A shares. And it trades about, I think it has open interest in the range of 25,000 contracts or so. We typically, I bring this up because it was a really interesting, I thought, instance of rising volatility amidst a rising market, and how counterintuitive that seems to, I think, most investors who typically associate rising volatility, especially rising option implied volatility, with falling prices. And instead we saw the opposite situation this week, where the index was rallying really fast, and the options on this ETF, which I said again were fairly actively traded and pretty liquid, saw implied vol also going through the roof. And I think that was a really interesting trade. It's still kind of happening. And there's some structural reasons for why that may be happening we could get into, but it was something that was definitely on our radar this week.
We always love turning to you for our international volatility review there, Jared. I'm looking up some of these different Shanghai ETFs. I see the Dow Jones Shanghai, but there's no real options on that one whatsoever. I'll have to dig up the other one you were mentioning and see if we can parse some of the option flow as well. But, of course, all these Shanghai ETFs gapping up, like you said, and the Dow Jones one, no different, gapping up from about this. Gapped up earlier just a few weeks ago, and now it's gapping up again from about the 340 handle all the way into the 388 handle, so gaining 40 odd points. For those of you who follow the Dow Jones Shanghai Index ETF, which I'm sure is a legion of you. But yes, interesting stuff out here going on from an international perspective, and was certainly something we like to keep an eye on. Speaking of keeping an eye on things, I think a lot of people, aside from today's odd VIX option activity, a lot of people in the volatility realm have been casting their eye a little bit further afield. We've been talking about it a lot here on this show, as well as pretty much all of our other programs on the network. It really is top of mind for a lot of people looking for volatility these days. That is, of course, oil. We had talked recently on this program and others about the Saudis coming in, and I think allowed the market really assuming that they were going to step in around that 70 level and really support it. Coming out now and saying they're not going to do that. They're not really going to support that price level, and they really seem to be more concerned about market share versus the actual price of oil. No, they're willing to let it slide a little more. Of course, that translates into a lot more price volatility out there in the product as a result. We've talked on recent episodes about how just ridiculously steep those puts had become. It seemed perhaps to a lot of people to be a bit overdone. In retrospect, perhaps not. A lot of those puts are actually at the money or in the money now. We're trading around the 70 handle in a lot of these products. We saw some aggressive moves even beyond that into the mid to low 60s. They were kind of near-term moves. They gapped down there and they kind of gapped right back. So we did see a little bit of support down at those levels. And of course, all of that price movement translating into a lot more in the way of volatility of late. Of course, interesting enough, too, we actually are starting to see maybe some of that near-term pop in crude, giving people some look again to the upside. We're starting to see a little bit of life, not a lot, but a little bit of life start to move into the north side, the northern region, the call region of that crude skew. Still is, of course, if you look at it, listeners, still predominantly listing and leaning towards the puts. Those puts of all stripes, all expirations, having a ridiculous amount of premium built in there. People obviously still concerned that there is downside to the 60 strike and perhaps even beyond, which is really, really interesting. But starting to see a little bit of life in some of the nearer term calls as people perhaps specking to try to capture on a delta basis, perhaps even some of these gaps up we're seeing in the futures as well. So all kinds of interesting, crazy stuff going on out here in the land of crude volatility. Of course, crude USO vol actually coming off a little bit in the last couple of sessions, be reaching a high very recently, earlier this week actually, of around the looks like about the nearly, actually it got into the 40 realm. OVX, of course, being the crude oil vol index out there. Mr. Sebastian, I think we'll start with you. I know you guys mostly look at oil from a USO perspective, but I'm sure this has been top of mind for a lot of your chatters and mentees over there. What's really catching their eye out there in oil, and what are they thinking going forward?
I mean, a lot of guys are still playing it short. I mean, the news today, it means more strength for the dollar, which is just kind of piling on, especially if the Saudis aren't stepping in. That being said, I think that we're finally starting to see some opportunity really develop in some of these names to the point where they're getting pretty cheap. And, it's hard not to want to invest in some of these. I look at a name like RDS, Royal Dutch Shell, and it's trading $67 and pays a 94-cent dividend potentially. So we're talking about like a 5.5% dividend yield on a very large conglomerate. And these guys, these big boys, are going to have the opportunity to basically, if prices get to the point where a lot of these drillers get really hammered, who do you think's going to be buying them out of these different bankruptcies? It could be potentially great for some of the diversified refiners and sellers of gasoline and oil-based products.
Actually, it will be the Longo Energy conglomerate that will come in and step in and scoop up a few of these on the cheap, because that's my side business. I'm not sure if you're aware of that.
Well, yeah, you need oil to produce the fabric, the polyester fabric for your mock turtlenecks.
We have many of those. Legion, they are, as we will. And very, very fancy. On the soon-to-come Options Insider store, coming to a website near you. But, Jared, I know you watch a lot of the crude stuff as well, obviously. What's your take on what's been cooking out here, the price action, the volatility, and everything else we've been seeing out here in crude oil over the past week?
That reminds me, I've got a problem, a customer service problem. The Options Insider ascot that I ordered has not come in.
Well, you have to order it in a package with the smoking jacket, and then
I have an
you get both.
Insider Dickie that I would like to wear around. I've been
very
waiting for
fancy.
a new one.
It's very fancy. It's for the Scooby-Doo rage that's kicking off in America again today. One thing I would note is that the short interest in speculative positioning in crude oil futures, I think, has been a pretty great tell. Especially most recently, we look at this a lot for VIX futures positioning, but you can do this in several other markets. I think have really meaningful data to look at. And crude is one of them. Eurodollars is another. The traders classify it as speculative, not as commercial hedgers. In that reporting data, had really taken off a lot of their short positions, had closed them out after some of the big moves to the downside. And as a result, I think this week we've seen, certainly quieter price action in the commodity. And that this is a little bit of storytelling. Obviously, you can fall into some narrative fallacies here, but it certainly makes sense to see this kind of quieter price action, given that some of the most aggressive, most speculative traders had closed out their positions based on the prior CFTC data. So when you combine that with the fact that option markets have kind of confirmed the move, they've dropped bids for premium pretty dramatically as prices have quieted down. I think that you got the makings for possibly a tradable bottom in the commodity. I know that there's definitely a value case building, as you guys were just talking about, for some of these equities. For quality names, I think there's also potential for some problems in the medium term. A lot of the really, really aggressive leverage drillers and the regional banks that service them had
come under a lot of pressure even early this week as traders started to look at what their coverage ratios were and what the leverage that they were using was. I think that if you see continued pricing for oil in this range, not necessarily even further downside, but just a continued turn at these price levels, I think it could cause some real problems for some of these leverage lenders and the companies that have borrowed from them. So I think that for anyone who's interested in maybe looking at some value, I think that it's going to be really crucial to be selective right now until at least until the commodity starts to rise again.
You know, it's interesting you mentioned the positions of the shorts, because you're right. I think only the most committed short at this point wouldn't have closed out at least some of that position. I think that's probably also maybe perhaps to blame for some of that bounce we saw immediately once we got down to that mid-60 handle out of these shorts saying, okay, I'm giving up the ghost. I'm closing out. It's been a good run. You can't really argue with the move from the 90 handle range all the way down to the mid-60 handle. If you're a short and you were still holding out, you were getting pretty aggressive out there. And again, that could also be perhaps why we saw some of the explosion of vol that we saw in the last couple of weeks coming off a little bit, at least in the latter portion of this week, as some of those guys closing out and playing the wait and see game, moving on into the wait and see portion of the trading spectrum. Really quickly here before we move on to another product, just jumping back to that ETF Jared was mentioning earlier. Ticker symbol listeners was ASHR. That is the Deutsche X-Trackers Harvest China A-Shares ETF. Usually does about 1,400 contracts a day. Of late, it has been lighting it up to the tune of about 5,000 today. So a lot of paper out there, and that's the ETF he was referring to, that also has gapped up quite a bit from the low 30s all the way up to about 35 or so today. So if you're interested in playing a little bit of action out there, a little bit of volatility out in those markets, ASHR, maybe an ETF you want to take a look at. We'll look at a couple more commodity elements here before we move on into some of your questions and comments as well, listeners. And one of the other commodities I know you guys like to pay attention to is, of course, what's going on out there in the shiny stuff, the metals. We'll kick things off again, as we like to do out here in gold. Gold hadn't been, in the last few shows we were talking about, hadn't been the most scintillating of things to watch, certainly not in comparison to what we saw going on out there in products like crude oil, which were really, really moving and shaking. Then it's time to start to get a little bit of life to it again out there in the product from a volatility perspective. Remember, we talked earlier on the show that everyone and their mother from the options perspective was really leaning heavily towards the puts for a while. They're out there in the precious metals, particularly in gold. It looked very much like a typical equity option or an index option from a skew perspective. Then that seemed to balance out again, and we got kind of into that little bit of equilibrium / boring period again where not much was afoot. And now we're seen to be leaning back again towards the put side of the equation, with a lot of premium diving in to quite a few of those puts. So most of the at the money is focusing around the 17 to 18 from an applied perspective, with the puts getting well up into the 20s, mid to low 20s from an implied vol perspective. So clearly a bit of a bias toward the puts out there. Interesting to see that starting to develop, but perhaps not entirely surprising given some of the price action we're seeing in other products like the dollar and indeed crude oil and things like that. Maybe we'll flip it over. Mr. Sebastian, anything catching your eye out there in gold land over the past week?
You know, vol keeps coming in, but I mean, we were having a discussion about this. I am having a lot of trouble finding a strong bull case for gold and a strong bear case for volatility in gold. You know, I can't find one. And I would be super excited to learn about. But as of yet, just not seeing a lot of great reasons to be long gold.
Clearly, at least the futures options, I'll have to pull up GLD as well. They're usually in lockstep or pretty close to it. But clearly the options are agreeing with you, again, skewing toward the downside these days, as perhaps the better part of the market saying, yeah, we can't really find a bullish case for gold much either. I know there always will be the gold bug contingent out there. They will never be dissuaded. They will be long gold till the end of time and perhaps beyond into the apocalypse. But aside from that very, very hardcore, diehard faction, the rest of the market perhaps saying maybe this is going to be a little bit of a weak period for the shiny stuff. Mr. Jared, what caught your eye out here from a metals vol perspective this week?
You know, I saw some big trades go up in GDX. That's the gold miners ETF. Last week, people looking to, from what I could tell, it just seemed like a trade. It was bullish in deltas and long vol, net kind of a spread that looked like possibly just someone who wanted to get that levered beta to GDX on a possible rebound in the commodity. But yeah, implied vols come off a little bit lately. One interesting bigger picture view that a friend of mine passed along this week had to do with gold as a way to get exposure to dollar, U.S. dollar exposure and rates expectations for the next 6 to 12 months. If you have a view on, say, 5-year break-evens and where they should go, he was arguing for gold as a proxy, maybe more attractively priced to do that. That may be a little bit more technical than we would get into normally here, but you can use anything as a proxy if it correlates in the way you want, and gold does have some possible virtues in that respect. Although, as you said, the fundamental case for its biggest fans, especially as a end of the world hedge, I mean, if that view ever is going to die, it should have died by now. I think in terms of the plausibility, when even relatively sympathetic folks in the media are willing to sort of poke fun at the late night infomercial crowd selling gold. I think that view is probably dead. Of course, there's always going to be someone come along with a contrarian approach and say, no, that means it's more attractive than ever, right?
Yeah, no, Jared, it was funny. We were having a discussion about this, and a couple of my guys that are short gold are basically like, I read that stuff just to, stop getting the confirmation bias. And he's like, I have yet to find a good analysis on gold at these levels and with current market conditions that doesn't involve a tinfoil hat.
Yeah.
And then I said this. I said, honestly, if you want to play the end of the world scenario, the better investment is guns and canned food than gold.
Yeah, right. Yeah, I mean, no one's going to be around to redeem your financial claims in that kind of world, and so right. Yeah, I'm a big believer in humanity and society, and for that reason, I like financial assets that benefit from our collective efforts. Right.
You can always use the guns to get more assets.
Way to throw in the collectivism there.
I just mean working together to achieve greatness. Go USA.
The philosophy major always sneaks into the show once or twice a week here on the old program. But yes, you're right, Mark. At the end of the day, you can always use the guns to get more assets, whereas gold may have questionable value in the apocalypse. And you're also right. When it comes to tinfoil hat land, I said this before, but I don't mean to demean all gold traders by any means, but I've certainly encountered a larger percentage of those in the gold product than perhaps any other product I've ever looked at, even in the heydays of the Apple zealotry. We're still talking the gold bugs dominating them. Really quickly, also, we mentioned the GLD, of course, GVZ being the volatility index on that GLD. That has come off quite a bit. We saw a bit of a spike last week going into the holiday, actually, where gold has a bit of price movement. Got GVZ gapping up into about the 25 range. I know a lot of you don't follow it because nobody trades it, but it still is an interesting measure of what's going on out there in GLD land now. GLD, of course, GVZ, hovering right around the 20 handle, so coming off about 1/4 point again today. So as we said here, a lot of stuff cooking, but not a lot from a volatility perspective yet in that product either. We'll pay attention to that. As Jared alluded to, there could be some potential trades on the horizon as people look to gold as a proxy for other areas. Meanwhile, we're going to keep on rolling, give you guys a chance to chime in on the old program. It's time to open up the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, and welcome to the volatility voicemail segment. This is indeed the portion of the program where we let you guys chime in on the old program, make your questions and comments known to us. As the announcer said, no shortage of ways for you guys to do just that. I illuminated a lot of those at the top of the show. I won't dive into those again, but I will kick things off with an interesting question. We actually received it on another program on the network here, the Advisor's Option. That's a program, listeners, if you're not familiar with it, that is geared towards the financial advisor, asset manager community, as well as their clients out there who want to learn more about the options world. And we had an interesting question come in from one of the advisors on that show. He writes here, this is from Michael Roberts. He writes, I came across your program while looking for new diversification options for my clients. I find your suggestions about collars and protective puts very interesting. Again, we talk a lot about protective strategies on that program, listeners. But again, I thought this question was interesting. I wanted to get your guys' take on it as well here because this is our volatility program. He goes on to write, I've also been reading new research about volatility itself being positioned as an alternative asset class. This leads me to two questions. One, do you agree that volatility is indeed an asset class? And two, what is the best process to gain exposure to that asset class for my clients? Is simply buying an option with a substantial Vega component sufficient, or must I purchase a dedicated volatility asset such as VIX Options or an ETF like VXX? Well, listeners, if you listen to the program for any length of time, you know how we're going to weigh in on that latter question. I've already had a chance to say a few things on this question on the other program, so I'll give you guys a chance to chime in. Mr. Sebastian, perhaps we'll start with you. What do you have to say for our friend here, Mr. Roberts, who asked some interesting questions about volatility? A, is it an asset class? And B, how best should he approach it for his clients?
You know, I always get kind of torn whether it's an actual asset class or whether it's a piece of the equity of a piece of the asset that it's being used in. But first off, let me start with don't ever use VXX or any of the ETNs as a long-term hedge. Then let me say that, like I said, I'm often torn whether they're really an asset class or whether they're really a complementary piece of something bigger. My general feeling is, is that, as an actual asset class, no. I mean, I would classify VIX as just an option, a alternative to an option in whatever class you're trying to hedge, not as its own class. That would be maybe my take on it. That doesn't mean that I don't think they're important, but I don't know that I would describe them as an actual asset class. I don't know, Jared, what do you think?
Yeah, it's a tricky question. I think we have to define. I mean, the answer really depends on how carefully and what way we define some terms. If we, what counts as an asset class? Is it if it's some securities or assets that have return streams that are economically different from one another, that are driven by different, core economic activity, then I think you can make the case. I mean, if we think about the difference between a stock index and a rolling constant position in put options on that stock index or call options on that stock index. I mean, if you net out the part of the return on an option contract that's driven by the delta, driven by the exposure to the underlying, if volatility was not an asset in any conceivable way, then I would argue that there shouldn't be any additional return or cash flow or whatever linked to the performance of the option contract. But of course there is. There's that premium that's associated with implied volatility. And as a result, I think you can argue that if you're really careful and if you actually do net out the returns associated with the underlying equity or commodity or whatever the underlying is, that there is an additional element that's priced in the contract that can be traded in either direction. And that's why we have all the strategies that we do use to trade options. I agree with, and I'm actually very sympathetic with people who resist this idea from an asset allocation sort of money manager point of view. Sometimes people have proposed that, fund of funds or large investment managers should actually have a little bucket in their in their big picture product suite, alongside equities and fixed income and commodities. They should also have one for volatility. And I think that that's possible, but I think that it's very difficult to do well, especially if you don't have a lot of detailed product knowledge and basically options traders and strategists. So I'm sympathetic to the criticism, but I think that if you do look at the literature, there's some interesting trading strategies, and there's some interesting elements of what drives option prices that simply aren't present in any other asset class. And I think that's actually the best argument. Just like you can't get some of the return elements associated with fixed income just by trading stocks, I think there are return elements in options markets and information in options markets that literally aren't reflected in other assets. And I think that's the best argument for regarding options and volatility as a distinct asset class rather than as just one flavor of exposure to others. That was actually only half the question, though. I just realized I didn't answer the second part of the listener's question about how to get exposure. But I'm not going to. That's too big of a question. I mean, there's so many ways to trade volatility.
It's impossible to answer that question without knowing what exactly he or she is trying to hedge and what they're actually doing. That would be the other pice. Right,
that's kind of the point of the whole show. We try to do some education here every week, and that's, I think, part of the very long-term goal of the program, right? Is to educate and discuss how to use this asset class as a tool. And there's so many ways, but it does depend on where you're coming from, where you're starting from.
Yeah, it is right. A very divisive question. That's why I wanted to bring it up here as well. This is indeed our volatility program to get you guys to chime in on it as well. It seems like the drumbeat for VIX as an alternative asset class really got stronger a couple of years ago when the correlation across a vast array of products that advisors and asset managers would typically use to diversify, like gold and others, really started moving in lockstep. They really were moving one-to-one. So the diversification value was very, very minimal in a lot of those products compared to what it used to be. So VIX, being one of the sole products that had any sort of inverse correlation, however tepid it might be sometimes, was very attractive. A lot of people started embracing it in that sense. So if you're looking at it truly in something that has some sort of inverse correlation, that made it attractive. Does that make it an asset? Probably not, but still, that seemed to be the loudest drumbeat. As things have started to move on their own a little bit again, that drumbeat seems to have lessened a little bit. And I think in general terms here, Mr. Roberts, if you listen to the show at all, we kind of tend to lean towards the more direct approach anyway, like you're kind of referring to here, buying options with a Vega component. That could be a longer-term S&P put if you're a broad index guy or things like that. And we typically tend to favor that approach here over the myriad volatility ETPs that Mark described here earlier. Got time for one more here. This comes in from Joe Hill. He writes, SPY versus SPX versus E-mini options. This is my question for volatility views. He writes, hello from Georgia. Well, hello there, Mr. Joe Hill. He writes, I know that these products are supposed to be similar from an implied volatility perspective, but how similar are they really? After all, they are distinct products, each with its own volume and customer flow. Do they all trade in a similar fashion, or are there times when these products will exhibit discrepancies? Lastly, can we get a show on just commodity vol one of these days? Thanks for your time, Joe Hill. Well, I can answer the last one really quickly. And we touch on commodity vol a lot here. Of course, Mr. Hill, and we do have the Futures Options Roundtable show on the network. So between those two, you get a lot of commodity dose. Certainly, we've upped it compared to what we used to do a year or two ago when it was primarily equity vol. Commodities being a lot of the action right now from a volatility perspective. If we didn't talk about oil today, that would get rid of half of our conversation. So certainly, we are talking a lot more about oil. If there is demand for a standalone commodity vol show, let me know right in. Maybe we can investigate that. But for right now, it seems to be good to mix it in with the broader equity vol as well. The other part of the question is very interesting. Of course, bulk of my exposure came in the SPX days when I was out there trading that product, and then later with the E-minis and a few of those as they started coming online. But you're right, they are similar, but they do have distinct patterns. Just pulling up really quickly here before we get into it, just looking at just straight up, you're talking about the end of the year time frames. I pulled up DEES across all of these. Talking nearer terms, so vol is a bit of a subjective term, but still, at the money implied. So the SPX right now is about 10. The SPY right now is about 11, and the DEES E-mini in that time frame is about a 9. So right there, you show there's a little bit of idiosyncrasies between the products, because you're right, they are individual products with their own paper flow, their own customers. That said, the larger trends do tend to move them in lockstep. You're not going to see someone come in and load up on a ton of, let's say, out of the money puts in one of them and not seeing correlating paper flow in others as other customers come in to buy those up and adjust those. And so you're going to see a lot of the big trends being similar. But again, you can see individual discrepancies like you mentioned here on the old products, because they are indeed individual products. Maybe we'll flip it over this time. Jared, we'll start with you. What do you have to say for our friend Mr. Joe Hill and his question about SPY versus SPX versus E-mini options?
Yeah, I think if you saw a real meaningful divergence that persisted for any length of time, it would be an arbitrage opportunity because those products have track the same underlying more or less, and so if you did see meaningful divergence in implied vols, you could take advantage of that and probably put together a really nice arbitrage. Although I think that given the depth and extent to which these products are followed, I don't think that would ever. I'd be really shocked if that occurred, especially in any regular way during a given trading session. I mean, options markets are incredibly efficient, and you don't have to get into the weeds on any strong versus weak efficient market hypothesis at all, actually, before. I mean, unless you're just have a real radical view on that. I mean, locally and over short time frames, especially across different products, markets, including options markets, really are very, very efficient. So if there are any opportunities like that, they tend to be captured very, very quickly, and people invest a lot in technology to identify exactly those kind of opportunities. So it's not something to worry about, I don't think, from the standpoint of an individual investor.
Mr. Sebastian, take us home for our friend here, Mr. Joe Hill.
Yeah, I think the only real difference between those is, where the liquidity is. And if you're a very small investor, SPY makes some sense, or the E-minis. But if you're looking to do any real size, the liquidity lands in SPX. And so that's really the only major difference is there's legitimately no way to arbitrage those different products, except for with incredibly low friction in your execution and in your costs.
Yep, no real discrepancies that are meaningful, at least for you guys, of the vast majority of our retail listeners, and certainly a lot of our institutional listeners as well. They play this stuff, but it gets this stuff. It is almost the same at the end of the day. So you're not going to see one wing of one getting crazy out of whack compared to the other two. It's just not going to happen. Unfortunately, maybe in the old days, perhaps, but not so much these days. All right, that's going to do it for the Volatility voicemail. Now we're going to dive right on into a really quick crystal ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome back to the Crystal Ball. This is the portion of the show that Jared's compliance officer just hates because Jared goes off on reckless and wild tangents, guesstimating and prognosticating on just about anything he can get his hands on. I have to rein him back in quite often here on the show. We expect that from Mark, but not so much from Jared. Yet this segment really seems to bring out the wild side in him. So we'll start with you, Jared. What crazy, reckless, wild volatility prognostications do you have in store for us for the week to come?
Wasn't that the name of our band?
Listeners, both Marks are really full of it, and I'm just for the record incredibly circumspect and in compliance with all relevant state and local regulations.
I take deep umbrage as that, sir, to quote Mr. Andrew.
In terms of the short-term outlook, this is. I mean, I've been thinking that we might have an opportunity here for one last great short vol position into the end of the year before, at least in my view personally, 2015 kicks off something possibly fairly new. You've had such a big improvement in economic data in the U.S. The data print today and for wage growth was 0.4% month over month, which is one of the biggest prints. I think it's the second best, or if not the best, monthly gain in wages since the recession. And I think that that's going to continue. We're going to see more of those. And so if there's any risk in terms of the Fed's timetable, it's a risk of being pulled forward, not back. And all of that points to the possibility of more realized volatility in the market as people have to reposition themselves for a fundamentally new policy environment. I think that's going to be the biggest story next year, and that a lot of people are getting that wrong and haven't adjusted their outlooks for that. But with all that said, for the very short term, markets are quiet. Everything is fairly rosy, at least in the U.S. And I think you can have, if you actually look at how short vol positions and strategies have performed in the last month or two, they actually have not done as well as just a vanilla long beta position. So in fact, I think there might be a little bit of edge, possibly, for short vol versus, and so rather than just long beta along the index into the end of the year. And I think that's something you can trade in a lot of different ways.
Certainly a lot of the option flow out there in VIX land seems to agree with you, at least in the near term these days, Jared. We'll keep an eye on that for next week. Mr. Sebastian, close us out here. What are you watching for the week to come? What's your wild, reckless prognostication?
I think that when we get together this time next week, we'll be right around 2100, and we'll be talking about a potentially sub-11 VIX.
Again, paper flow, not really arguing with that viewpoint today, at least, either. So we'll pay attention and see how we're looking as we come into next week. Meanwhile, unfortunately, that's all the time we have for this episode of Volatility Views. But before we go, as always, I'd like to check in with each of my cohorts here on the old Volatility Views team to see what they have coming down the pike that may interest you. We'll mix it up one more time. Mr. Sebastian, starting with you. What webinars and events and myriad other things do you have cooking over there at the pit that may interest our listening audience?
We got our boot camp starting Tuesday. The Option Pit boot camp. Go to optionpit.com/bootcamp. Use code INSIDER to take 20% off.
So listeners, if you like the idea of learning options while Mark yells at you and blows a whistle and wears a weird hat, appeals to you, then by all means surf on over to Option Pit and sign up for that boot camp. I think you'll find it very interesting. All right, and Mr. Jared, what's coming down the pike in the land of BGC partners?
Well, we came out with a report this week on looking at holiday retail sales expectations. There was some pessimism early this week. If you recall, when the Black Friday number came in worse than people had expected, we kind of faded that, looked at all the sort of just boatload of positive data weighing against that, and some ways to express that in terms of trading strategies. And for the very near term, we're still working on the 2015 volatility outlook. That's going to be coming out in client inboxes in the next few weeks. And we're also looking at some more technical monitors on equity indexes in Asia versus ETFs, some U.S. listed Chinese companies, and some really sort of a little bit more detailed stuff like that. So a lot of stuff coming out to suit the interests that folks have. And if you have your own interests, feel free to get in touch with us.
Sounds good. Thank you for that. I'm looking forward to hearing about that 2015 vol outlook. We can dive into that on a future show. And on behalf of Jared and Mark, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.